Charles here. 2016 AP Macro FRQ number 1. Let's see if we can do this one. Assume the United States economy is currently in short-run equilibrium with the actual unemployment rate above the natural rate of unemployment. So when actual is greater than the natural rate of unemployment, right? This is what we call a recession. We know we have more unemployment than is normal, and we are in a recession. They want us to draw a single correctly labeled graph with the long run and the short run Phillips curve, labeling the short run point P. So we have inflation for our Phillips curve on the vertical. We have unemployment on the horizontal. Short run Phillips curve is downward sloping. And long run Phillips curve is vertical. Doesn't change in the long run, right? We should know with our Phillips curve here that that point right there where they cross, that is what we call expected inflation. You don't need to know it for this one, but they've been asking it a whole bunch lately. So make sure you know that's expected inflation. This is our natural rate of unemployment right there, where these two cross. They're telling us our actual unemployment is greater than our natural rate. So we know that we're somewhere on this side of our long run Phillips curve. Let's just choose a spot here. That would be our actual inflation. This would be actual unemployment. This is our actual. That doesn't look like actual very much, but that's actual unemployment. And this would be our actual, I'm not going to write it all out, inflation. So this is point P. Easy enough. Now they're saying, assuming that no policy actions are taken, that means no fiscal or monetary policies to fix this problem, will the short run Phillips curve shift to the right, shift to the left, or remain the same in the long run? And explain. To do that, we're going to take a little sidestep. We're going to talk about what if we draw an aggregate demand and aggregate supply curve graph to show our recession, right? Because we should recognize by this point that our Phillips curve is just a representation of whatever's going on. Long run aggregate supply, there we go. Short run aggregate supply. Nice, and aggregate demand. All right, here we are in a recession. Right there, that's our price level. We'll call it PL1. And this is our real GDP, we'll call it Y1. This is YF, that's full employment. We can tell that we're in a recession. We can tell that unemployment is higher because we're in a recession and prices are really low. Actual inflation. Inflation and price levels, same thing, right? So low inflation, low price levels, right? Now, what we understand here is that if there is no policy action, there's no fiscal policy, there's no monetary policy, in the long run, a couple things are going to happen. Wages are going to fall. If you're out of work, you will accept lower wages to go back to work so you can eat. We also know prices are falling, so we should know and be able to explain it that input prices are falling. Input prices are all the prices for the stuff that you create as a business, right? The things, the materials, their prices are going down, wages are going down. Both of these together are what we call business costs. That's an easy way to sum it up. If business costs go down, our short-run aggregate supply curve is going to shift to the right. When short-run aggregate supply curve shifts to the right, we go back to full employment at a lower price level. And back there at full employment. Now, a rightward shift of our short-run aggregate supply curve is a leftward shift of our short-run Phillips curve. So let's draw that in. And you have to play with these a little bit, these graphs, to make sure that we can explain this and recognize what's going on, using arrows showing what's going on here. But can we see that we're back to full employment? Right there's our natural rate. And at a lower price level. And that's exactly what happened down here with our aggregate demand and aggregate supply. Short run aggregate supply curve shifted to the right. And we went back to full employment at a lower price level, right? Here, I know my short run Phillips curve shifted to the left to give me that lower price level back to full employment. So they're going to ask us, will the short run Phillips curve shift to the right, shift to the left, or remain the same? We're going to say it shifted, obviously, to the left. Give us that. The explanation is this information here. Wages and input prices of business costs fell, which would shift that short run aggregate supply curve to the right, which would shift the short run Phillips curve down. Inflation, price level went down, back to full employment. All of that together would be our explanation. All right, C. If the Federal Reserve Bank wants to lower unemployment, what expansionary output markets should it use? Open market operations. We should know that the Fed, to lower unemployment, would obviously buy bonds. That is its open market operation, buying and selling bonds. So they're going to buy bonds. I don't think any explanation needed. Just have to say buy bonds. How will the open market operation you identified affect each of the following? The federal funds rate and the real interest rate in the short run. Understand that your federal funds rate, we need to know what it is. And it is just a rate of interest that banks charge one another. So your federal, okay, back with you guys, I think. Can you hear me? I hope. Yeah, there we go. So how will the open market operation, what we know is we have a little chain of thinking here that we know that when the Fed buys bonds, when they buy bonds, I know some certain things happen, right? I know the money supply is going to increase. I know nominal interest rates are going to go down. Now, the federal funds rate is a rate of interest that banks charge one another, but it is just a rate of interest. So when the money supply increases and the nominal interest rates go down, the federal funds rate would go down also. And we could simply explain that and with this scenario, that as the Fed buys bonds, money supply increases, driving down the nominal interest rate. Therefore, the federal funds rate would also decrease. And that's a good explanation for that. The real interest rate, there's a little step here. Obviously, when the Fed buys bonds, the money supply increases, nominal interest rates go down, and we should know that real and nominal go in the same direction almost all the time. If you know what's going on with the nominal, you know what's going on with the real. Right? We also know that this is going to cause some other things to go on here. As the nominal interest rate goes down, I know investment is going to increase, right? Aggregate demand, therefore, is going to increase. Price level is going to increase. I also know that when the price level goes up, that affects the real interest rate also. When the price level goes up, real interest rates go down also. So these two, we know real interest rates are definitely going to fall. They don't ask us to explain it, but if we had to, we would want to use price level and nominal interest rates to explain those lower real interest rates. When aggregate demand increases, I know real GDP is going to increase. I know output, and I know these are really the same things, but I like to have them both. And I know that unemployment is going to decrease. Right? So this is our causal chain of thinking. Buying bonds makes the money supply increase, nominal interest rates go down, investment goes up, aggregate demand goes up, price level goes up, real GDP goes up, output goes up, and unemployment goes down. And that's exactly what they were trying to do with those open market operations, was make unemployment go down. All right. Given your answer in part D2, what's the effect on real GDP? Now, we've already really answered that. Here's real GDP is going to increase, and we just need all of this information to explain it, right? Really, you would say buying bonds increases the money supply, lowers nominal interest rates, increases investment, aggregate demand, and therefore real GDP. To explain why real GDP increased, you better have aggregate demand. To have aggregate demand, you better talk about a determinant of aggregate demand, and we want to talk about the reasons why all of this happens. So this is our causal chain of thinking. Once you know it, it's easy to add in there to explain those answers. All right, F. Japan and the United States are major trading partners. Indicate how the change in real GDP, you identified in part E, will affect the demand for Japanese yen in the foreign exchange market. All right, so real GDP can also be thought of as income. So let's do this. Here's the U.S. Their real GDP has increased. We always want to think about that as incomes have gone up, right? Here's our foreign exchange. Call it the big FOREX in the sky. And here, who are we messing with? Japan. Here's Japan. That implies that their real GDP is relatively lower, or their people's incomes have not gone down. I mean, we're just going to say that. We know ours are gone higher, so relatively theirs are lower. So as our incomes go up, we're going to buy more stuff from Japan. What's going to happen to the demand for Japanese yen in the foreign exchange market? Well, as the U.S. is richer, they're going to buy more Japanese stuff. So to do that, they have to take their dollars, right? And they dump their dollars into the FOREX and buy yen. So they can pay. Japanese only accept yen for their goods and services, which we want. So U.S. citizens take their dollars, they dump them into the FOREX, and they buy yen. The demand for yen just increased. And we should know that the foreign exchange would be, this is going to be the demand for yen. So we would have yen on the vertical, quantity of yen on the horizontal, and it is dollars to yen. Easy enough. What will, let me read it, make sure we answered it correctly. Indicate how the change in real GDP will affect the demand for the Japanese yen in the foreign exchange market. The Japanese yen will increase. The demand for yen will increase. We can see that right here. Draw a correctly labeled graph of the foreign exchange market for the Japanese yen, which we just did, showing the effect of the change in demand identified on the value of the yen relative to the US dollar. So we just want to go in here and make sure this is nice and clean. We can see that as the demand for yen increases, the value of the yen is going to go up, right? We can do this as E1, exchange rate 1, E2, and we could show something like this, Q1, Q2. So all we're really showing, making sure you've labeled the axes correctly. We're talking about yen, so it's yen on the vertical, quantity of yen on the horizontal, and it is dollars to yen. This is showing a couple things. It's showing the value of the yen going up. It's also showing that it takes more dollars per yen to buy yen. Since the value of the yen is going up, it's going to take more dollars to buy 1 yen. That's exactly what that arrow is showing there. All right, fairly complicated, but a good graph there. Good problem. All right, my friends, be safe, take care, and let me know if I can help.